Hello students and welcome back to a new lesson series from a very important chapter of your syllabus. Yes, accounting ratios. If you refer to the lesson series on analysis of financial statements, Siddhi and Vinny wanted to give Kavya a detailed understanding of the accounting ratios. And so, they are back today right there in the conference room for a session on accounting ratios. Let's start with the meaning of accounting ratios. As we have discussed earlier, accounting ratios help in understanding the solvency, efficiency, and profitability of financial statements. To define a ratio is a mathematical number which is calculated or derived as a reference to the relationship of two or more numbers. It can be expressed as a fraction, proportion, percentage, and a number of times. Now, when such a ratio is calculated with the help of two accounting numbers from a given financial statement, it is termed as accounting ratio. Vinny takes up an example to make Kavya understand. Say the net profit of an entity is rupees 1 lakh and the revenue from operations is rupees 5 lakh. It can be put that the net profit is 1 lakh by 5 lakhs into 100, that is 20% of the revenue from operations. This ratio is the net profit ratio and is expressed in percentage. Now, Kavya wonders what can be a ratio expressed in number of times, and Siddhi helps her out. Suppose the inventory ratio, which is calculated from the cost of revenue from operations divided by average inventory and is expressed in whole number. Meaning to say, this many times the inventory will turn into revenue from operations in a year. However, a ratio must be calculated with numbers which are meaningfully correlated. Calculation of ratios using entirely unrelated numbers would be of no use. Based on this, let us quickly understand the major objectives of accounting ratios. Accounting ratios, once calculated properly, helps the analyst or the user to understand which areas of the business requires attention on priority, to know about the potential areas which can be improved for desired outputs, to know a deeper analysis of liquidity, solvency, profitability, and efficiency of the business, to provide inputs towards cross-sectional analysis by an overall comparison to benchmarked industry standards, to provide information for projections and estimates. Based on the objectives, Kavya wants to enumerate the major advantages of ratio analysis. Explains the efficacy of decisions. Analysis of ratios help understand whether the entity has taken the most appropriate operating, investing, and financing decisions. It also measures the effectiveness of such implementation. Simplify complex numbers to establish relationships. Complex numbers are converted to ratios to understand the relationship, which in turn helps to analyze managerial efficiency, firms' creditworthiness, earning capacity, and such other parameters. Aid in comparative analysis. Ratios are calculated for subsequent financial or accounting periods. These ratios, when placed sequentially, give an understanding of the trend of the business. This analysis helps in making crucial business projections. Identification of problem areas. Accounting ratios are indeed a very useful tool to identify and thereafter work upon problem areas of business. The brighter areas on the other side gets polishing for even better results. Enables SWOT analysis is the analysis of strength, weakness, opportunity, and threat of a business. Accounting ratio gives insight to changes occurring in the business, which provides the inputs for SWOT analysis. Various comparisons. Accounting ratios help comparisons with certain benchmarks like over a number of accounting periods, inter-firm comparison, time series analysis with other business enterprises, intra-firm comparison, cross-sectional analysis with standards set for that particular firm or industry, industry expectations, comparison with standards. After the advantages, we will learn about the disadvantages of ratio analysis. As ratio analysis is primarily dependent on financial statements, the limitations of ratio analysis is directly linked to the nature of financial statements. Limitation of accounting data. Ratio analysis is primarily dependent on accounting data which reflect a combination of recorded facts, accounting conventions, and personal judgment. For example, profit at any given time is not a precise and final number. Conventions and personal judgments all contributes to differ. Hence, the financial statements do not reveal the exact true and fair view, and so goes for the ratios. Ratio analysis ignores price level changes. Financial accounting is based on the assumption that price level changes are either minimal or non-existent. However, inflationary economies reduces money power to a large extent, and ratio analysis does not take this into consideration. Not considering non-monetary or qualitative aspects, accounting only focuses on quantitative and monetary aspects, and hence ratio analysis does not get a scope to address non-monetary or qualitative aspects. Variations in accounting policies. Since different firms follow different accounting policies, a valid comparison of ratios from the financial statement is not practical. Forecasting loopholes. Forecasting based only on historical analysis without non-financial factors is not sufficient. And now, Kavya needs to understand the limitations of the ratios in particular. Ratios are considered to be means to an end rather than the end. Ratios are mostly indicative in nature and they lack the ability to resolve the problems. In many cases, there is a lack of standardized definition of different concepts used in this analysis. There is a gap in universally accepted standard level of ideal ratios. Ratios, if calculated on unrelated numbers, would mean a meaningless exercise. Hence, ratios should be used with proper consideration of their limitations while all the analysis and subsequent decision-making exercises. With this, Siddhi, Vinny and Kavya take a break. We too shall close the lesson for now. See you soon in the next part. Till then, happy learning.